If I were starting from zero right now, no investments, no portfolio, nothing, I wouldn't start by picking stocks. I wouldn't chase the hot fund. I'd do 3 things in a specific order, and the order itself is the whole point. Most beginner guides tell you what to invest in. Almost none of them tell you what to do first. That part is what we're fixing today. Here's the thing about investing that nobody explains. The assets themselves don't matter as much as the order you build them in. You can own the right investments and still lose because you did them in the wrong sequence. Skip steps and you'll panic when the market drops, pull money out at the worst moment, and end up back at zero. The sequence protects you from yourself. Before a single dollar goes into any investment, there's a prerequisite. It's not exciting. It's not a market play. And if you skip it, everything after it breaks. Here it is. You need money you will never invest. A separate pile sitting in cash that exists purely to protect you. Once you have it, step 1 can actually start. This is your emergency fund. 3 months of essential living expenses sitting in a high-yield savings account where it earns a little while it waits, but is never touched except for an actual emergency. Not a dip in the market, not a deal you don't want to miss. A real emergency, job loss, medical bill, the car that won't start. Why does this come before anything else? Because investing money you might actually need is the fastest way to become a bad investor. The market drops 20%, and it does, and you suddenly need cash for rent. So you sell at the bottom, lock in the loss, and tell yourself investing doesn't work. It did work, you just didn't have a buffer. The emergency fund is what lets you hold. You don't have to have 3 full months saved before anything else happens. If you have nothing, start building it with $50 a month in a separate account. While it builds, that money is not invested. That's the rule. Once it hits 3 months of your essential expenses, rent, food, utilities, basic transport, the gate opens and step 1 begins. Step 1. Once the emergency fund is solid, the first dollar you invest goes into safe, boring government bonds or treasury bills. Not stocks, not an index fund yet. Bonds first. And there's a real reason for this that most people skip over. Bonds and treasuries don't grow the fastest. They grow predictably. You put money in, you know roughly what comes out, and nothing dramatic happens. That predictability is the whole point. Investing is partly a skill and partly a psychological game. You need to practice watching money grow without the noise of daily volatility. Bonds give you that. They build your investor patience on stakes low enough that a bad week won't shake you out. Right now, well-structured treasury bills and short-term government bonds are paying 4 to 5% a year. That's a guaranteed return backed by the government that currently beats inflation. It's not going to make you wealthy alone, but it's doing real work and it's doing it without any drama. Your first investment should never feel like a gamble. Step 2. Once you're comfortable watching money grow and you've built the habit of consistent contributions, you add the second layer, a broad market index fund. This is where compound interest actually becomes a machine. Not a concept, a machine, running in the background whether you look at it or not. Here's why the index comes before individual stocks. When you buy an individual stock, you're betting on one company. You need to be right about its future. When you buy a broad index, you own a tiny slice of hundreds of companies at once. Some will fail, most will grow. You don't need to pick, you just need to hold. Time is always on your side with the whole market. It's rarely on your side with one company. Here's the number that closes the argument. $200 a month invested in a broad index fund, earning the market's historical average of around 8% annually. 30 years, no extra steps. The result, $400,000. Not from getting lucky, not from picking the right stock. From $200 a month, started and not stopped. The engine doesn't ask your opinion, it just runs. And here's the only threat to that machine. Compound interest doesn't care about bad news, election cycles, or market downturns. It keeps running through all of it, as long as the contributions keep coming and you don't sell. Every time someone panic sells during a correction, they reach into the engine and yank out a gear. The engine doesn't restart at the same speed. You lose the years those dollars would have been compounding. Now here's the piece that nobody names directly. There is a silent race happening, and you're already in it whether you realize it or not. Someone with your exact same income, starting last January, is now 12 months ahead of you in compound interest. That's not 12 months of growth. That's 12 months of growth compounding on top of growth. And that gap widens every single month you wait. Starting 1 month earlier doesn't give you 1 extra month of returns. In a compounding system, 1 month earlier is worth more at year 10 than it is at year 1. Time isn't linear in this game, it's exponential. So the cost of waiting a month isn't a month. Over 30 years, it's thousands of dollars that those dollars would have quietly earned and reinvested on repeat. Let me be clear about what I'm not saying. I'm not saying never buy individual stocks. I'm not saying crypto is a scam. I'm saying those come after this sequence is in place, not before. The reason most new investors quit entirely is that they start with the volatile stuff in year one, take a 40% loss before they've built any conviction, and conclude that investing doesn't work. The sequence exists so you're prepared for volatility before you meet it. So here's the sequence, final version. First, emergency fund, 3 months of essential expenses in cash, separate account, never invested. Second, government bonds or treasury bills, first investment, predictable return, trains your patience. Third, broad index fund, the compound engine, monthly contributions, long hold. Do these in order. Skip one and the next one doesn't work the way it should. Here's what the first 12 months look like if you start today. Months 1 through 3. Every spare dollar goes to the emergency fund, not to any investment, just the buffer. Set an automatic transfer on payday, leave it alone, watch it build. Nothing exciting happens here. That's fine. This is the foundation, not the engine. Months 4 through 6, the emergency fund is solid. Now you open the gate. Start putting a fixed amount into short-term government bonds or treasury bills each month. You don't need to pick the perfect instrument. You need to start the habit of investing on a schedule, watching money earn predictably, and not reacting to headlines. Month 7 onwards, add the index fund. Keep the bond contributions running. They're your stable layer. And now, alongside them, a monthly contribution to the broadest index fund you can access. Low cost, diversified, automatic. This is the moment the compound engine turns on. And from here, the only thing it needs is time and contributions. You provide those. It does the rest. One clear note before you go. This is education, not financial advice. Your situation is yours, income, expenses, tax treatment, country-specific options, all different. What I've described here is a sequence logic, not a prescription. Do your own research. Talk to a qualified advisor if the stakes are high. The principles here are broadly applicable. The exact instruments depend on where you live and what you have access to. So there's the whole thing. Not which asset, what order. Emergency fund first, then safe bonds, then the index that compounds for decades. The math isn't magic. It's mechanical. It only asks one thing from you, start. Not next year when you earn more. Not after you've done more research. This week. Pick step 1. The sequence is simple. The hardest part is always just beginning it. If this gave you the clarity to start, subscribe to Moff Money, where we break down building wealth, one honest step at a time.